If you have a pension overseas, whether it's from the US, UK or Australia or anywhere else, you're probably wondering how it will be taxed in New Zealand and what's a good strategy for taking the benefits. The tax rules around this are a little complex, but let's break it down so you know what to expect on any withdrawals or transfers and can start planning ahead. Hi, I'm Jim Smith, Senior Financial Planner here at Pacific Wealth. We specialise in helping new migrants and returning Kiwis navigate the intricacies of cross-border financial planning to help you make the most of your new life in New Zealand. In this video, we explained what an overseas pension is and how withdrawals and transfers are treated from a tax perspective so you can start developing the most appropriate strategy for you. Overseas pensions can come in many different forms. For example, it could be that you have a UK defined benefit or defined contribution pension arrangement, a US 401k or individual retirement account, or even a private retirement scheme or annuity held offshore. If you are tax resident in New Zealand, then these overseas pensions are normally treated as foreign superannuation schemes. As a foreign superannuation scheme, the pension is not normally subject to tax in New Zealand until any funds are withdrawn or transferred. This means the funds that you built up can continue to grow offshore, often in a tax-privileged environment. But once withdrawn or transferred and you are tax resident in New Zealand, these will be taxed under the foreign superannuation rules as either a periodic regular income or lump sum. If the withdrawals are made as a regular periodic payment, such as a pension income, then New Zealand will treat this as ordinary income and you'll be taxed on the income at your individual marginal rate in New Zealand. In theory, only New Zealand tax should apply and no tax should be held by the overseas scheme. But this is not always possible to achieve in practice and you may have to file a tax return or make an application to reclaim the tax back. If you are within the 4-year transitional tax residency period, which we covered in a separate video, then you'll be exempt from paying tax on the income payments in New Zealand until the transitional tax residency period comes to an end. Thereafter though, the periodic regular payments are subject to tax in full in New Zealand at your marginal rate of tax. Any lump sum withdrawals or transfers from foreign superannuation schemes are also taxable in New Zealand, but different rules apply. For lump sum withdrawals and transfers, individuals can choose one of two methods to calculate the tax payable. The two methods are the formula method and the schedule method. The formula method is the more complicated and will often require working with a tax advisor to calculate the tax due. But this can be worth investigating, particularly if you have a large pension scheme. The schedule method is the default method and the one most often used in practice. Under both methods, New Zealand grants a 4-year exemption period which is similar to the transitional tax residency rules. If you qualify for this exemption, any lump sum withdrawals or transfers are exempt from tax in New Zealand for the first 4 years after returning to New Zealand and becoming tax resident. After this initial 4-year period, any lump sum withdrawals or transfers are subject to tax at a progressively higher rate. The table shown here shows the proportion of the lump sum that will be subject to tax in New Zealand under the schedule method. You can see that the first 4 years are exempt, but thereafter a greater proportion of the lump sum or transfer will be subject to tax. To help illustrate how this works, if a $50,000 New Zealand dollar lump sum withdrawal happens 10 years after arriving in New Zealand, under the schedule method and applying the 4-year exemption, 27.47% of the withdrawal could be subject to New Zealand tax. Assuming a marginal tax rate of 33% would end up with an effective tax rate of 9.07% and a tax bill of just over $4,500 based on a $50,000 lump sum withdrawal. Whereas if the lump sum withdrawal happens 20 years after arriving in New Zealand, under the schedule method and applying the 4-year exemption, 67.84% of the payment could be subject to New Zealand tax. Again, based upon a 33 marginal tax rate, would end up with an effective tax rate of 22.39% and for a $50,000 withdrawal, a tax bill of just over 11,000 New Zealand dollars. The tax is normally payable after the end of the tax year in which the withdrawal takes place. From the table, you can see that the longer that time goes on, the greater the proportion of the lump sum withdrawal or transfers that will be subject to tax. But you also need to factor in the different tax treatments. If you withdraw all of your funds from the tax-privileged overseas pension and then reinvest the proceeds in New Zealand, you will lose the tax benefit of the overseas pension and the investment returns will be subject to tax in New Zealand. In this video, I hope we've provided you with an understanding of what is an overseas pension and how withdrawals and transfers are treated from a tax perspective, so you can start developing a strategy for planning ahead. If you are interested to learn more about financial and retirement planning issues that international migrants need to know when moving to New Zealand, we've created other videos that you can explore on our YouTube channel. You can also visit our website www.pacificwealth.co.nz, which has other information and articles and where you can book a free initial consultation. Thank you for watching, and if you found the content helpful, please drop us a like, comment and consider subscribing.